Welcome to Knowledge Update channel. This video is a part of ITFG series to create awareness on Ind AS practical problems and solutions. Today we are going to discuss on very critical and pertinent issues on accounting for dividend distribution tax, particularly in case of consolidated financial statements. And this issue is covered under ITFG Bulletin 13. Let us look at the facts of the case. H Limited holds 12,000 equity shares in S Limited, that is a subsidiary of H Limited, with 60% holding. Accordingly, S Limited is a partly owned subsidiary of H Limited. Why? Because H Limited holds 60% in S Limited. Remaining 40% is owned by other shareholders, which are called non-controlling interest or minority interest. Now, the question is that S Limited paid a dividend at 10 rupees per share, amounting to rupees 2 lakh, and dividend distribution tax of 20% amounting to rupees 40,000. So it's assumed that the DDT rate is 20% and subsidiary S Limited has issued or declared a dividend, and they have paid total dividend of rupees 2 lakh, and on that the DDT dividend distribution tax is of rupees 40,000. Now as we all know that it's 60% owned, so 60% of this dividend will be received by H Limited, and 60% of dividend distribution tax is ultimately paid because of the H Limited dividend. Let us look at the what is the question. What should be the share of H Limited in DDT paid by S Limited amounting to rupees 24,000 to be charged as expense in the consolidated profit and loss statements? Because if we just look at the intercompany elimination, first line to line consolidation is required when we do consolidated financial statements. So when we look at eliminations, there will be a dividend which is going to be eliminated with respect to the amount 60% of 2 lakh rupees of dividend which has been received by H Limited, that will be eliminated. So the only 80,000 rupees, that is the dividend paid by S Limited to the minority interest, that will be a part of the consolidated financial statements of H Limited, that will be shown as a by way of reduction of NCI. That is on dividend. Why? Because dividend is need to be eliminated. Dividend received and paid both need to be eliminated. Now let us focus and discuss about the dividend distribution tax. The DDT which is paid by subsidiary company to outsiders, that is the government of India. Now once you consolidate, at that time what will happen, the dividend income has been knocked off, but DDT is which is paid by the group to outsiders. So that is what is a expenditure for a holding company. So there will be a reclassifications of 24,000 rupees from a changes in equity to profit and loss statements, and in by that means what will happen, that there will be a charge of tax expenditures in the consolidated profit and loss statements of H Limited. So I hope that is very clear. So first point, which is step 1, is elimination, intercompany elimination of a dividend income. Step 2 is basically looking into the DDT and what is the dividend distribution tax which is being paid to the outsiders. So that is 24,000 is nothing but the 60% of 40,000 that is paid to outsiders, and the income has been received by the holding company itself. So that is nothing but the expenditure of H Limited, hence it is need to be reclassified from equity to profit and loss accounts when we prepare a consolidated financial statements. Let us look at the next scenario. We are going to discuss about 3 scenarios. And these three scenarios are different. They are providing a different perspective to the whole situations, and all these three scenarios are primarily on a dividend distribution tax. In the next scenario, what is happening that the H Limited also pays. So here if you look at H Limited also pays dividend of rupees 3 lakh to its shareholders, and DDT liability of 20% thereon amounts to 60,000 rupees. As per the tax laws, DDT paid by S Limited of rupees 24,000 is allowed to be set off against DDT liability of H Limited. So in the first kitchen, which when we discussed, we thought that we are the view that the amount of DDT which is payable because of the H Limited dividend, that is nothing but the expenditure of a consolidated group. Now the question is here where the DDT which is paid by S Limited, it is eligible to offset set off by H Limited. That means now whether it is expenditure. So what is question? One, what should the share of H Limited in DDT paid by S Limited amounting to rupees 24,000? Is it to be charged as expenditures, which was done in the earlier case? And second question is that in case if the H Limited pays dividend of rupees 1 lakh, so in the first situation, dividend paid is how much? 3 lakhs rupees by H Limited, and that's why the liability is how much? 60,000 rupees. In second situations, dividend paid is how much? 1 lakh rupees. So liability is only 20,000 rupees. So let us look at the first case where 3 lakh into 20%, 60,000 rupees is what the liability of the H Limited. Out of 60,000 rupees, 24,000 rupees DDT which is eligible to say offset. So in earlier case, when we disclose is as expenditure, now it is no more expenditure because H Limited is eligible to offset the dividend distribution tax against the liability of H Limited, that is the 60,000 rupees. So here if you look at what is done, it's only here the first is the elimination of the intercalculation of a dividend income, and then the 40,000 rupees, that is what is S Limited, and 36,000 rupees H Limited, they both combined come to 76,000 rupees as a part of equity. There is no charge of dividend distribution tax in a profit and loss statement because this is eligible to offset. Let us look at the second situations. Here what happens, the amount of dividend which is eligible is higher because H Limited is going to pay higher DDT. In case of second situations, the H Limited pays dividend of only rupees 1 lakh, right? So the DDT will come to only 20,000 rupees. So offset is of 24,000 rupees, which is higher than the DDT liability of H Limited. That means there is a deficit of 4,000 rupees. So 4,000 rupees need to be reclassified from statement of changes in equity to profit and loss account in the consolidated financial statements of H Limited. I hope that's clear as far as this particular two scenarios is concerned. First thing is that as a group we have to look at, as a group, is it expenditure or not? With expenditure, you will reclassify from equity to P&L account. As a group, if H Limited is able to get offset, there is no expenditures, then till that amount there is no issue. Excess need to be reclassified to P&L account. Now coming to the last situation, scenario 3. This scenario 3 is basically a case where uh, if it is a DDT is paid by associate. In scenario 1, scenario 2, we discussed about the case where the subsidiary company. Now it said the DDT is paid by associate, and what should be treatment in a consolidated financial statements if, as per tax laws, the DDT paid by associate is not allowed to be set off. So now here what happens that associate has uh, issued a dividend, declared dividend, associate has paid dividend distribution tax. Once associate is paid dividend, obviously the investor holding company is going to receive the dividend income. But what about the DDT? dividend distribution tax which is being paid by associate. Now here, as the associate is not allowed to set off, what will happen that there will be credit to investment account and there will be debit to sharing profit loss of associate. In case of investment in associate, there is only a one line consolidation, and the one line consolidation is what? Sharing profit or loss of associate is being taken to part of the consolidated profit loss statement. So there is no separate line item. So there will be a debit to sharing profit loss of associates in a consolidated P&L account, and a corresponding entry will be by way of credit to the investment in associate accounts. So that is what is a primary focus, and I hope that this series is going to be really helpful to you. And in case if you have any suggestions, in case if you want to provide some kind of inputs, please let me know. I will be more than happy to consider in my next video. Thank you so much.